Greetings, everyone. Scott Richardson, Dan Brown from Richardson Capital Management, here to present the July Economic and Investment Update. Well, July was another interesting month in the financial markets. We had a strong start to the month with the stock market, with the Standard & Poor's 500 reaching an all-time high near the middle of the month before it sold off a bit the last 2 weeks or so, made a strong rally the last day of the month, and finished up percent or two positive, which was good results. What was interesting was we saw a pretty sizable rotation in the leadership in the stock market this month. So the prior 6 months, the gains have come almost exclusively from large capitalization technology stocks. And starting this month, we saw a nice rotation where small capitalization stocks and value stocks and some international stocks actually kind of took the lead, performed more favorably than the larger cap tech stocks that have been leading the way. So that was an interesting turn of events. But long story short, positive returns for the equity markets for the month. And then in the fixed income world, we saw some nice returns as interest rates fell during the course of the month. I think the 10-year Treasury started at about 4.5%, ended closer to 4.1%. And as we all know, when interest rates go down, the value of bonds goes up. And so the bonds were up for the month, and that turned a lot of them into positive returns for the year-to-date performance so far. So decent returns in the financial markets. And the key question is, what caused that activity? And with that, I'll turn it over to Dan for some thoughts.
Yeah, thanks, Scott. So the two primary catalysts that caused that rotation that you talked about, one was investor expectations that the Federal Reserve would begin to cut rates fairly soon. Markets interpreting that as probably the September meeting, and we got that confirmation mainly because Jerome Powell spoke a couple times early in the month, first at an investor summit over in Europe, and then secondly, testimony in front of Congress. So hinted pretty strongly that rates were coming. And then secondly, mid-month, we saw a very favorable inflation report, specifically the CPI or Consumer Price Index report, came in very tame, very soft, again, giving the indication that the Fed could cut rates. So that led to a lot of interest rate sensitive stocks like small caps and value outperforming. Again, they've underperformed quite a bit the past 6 months or a year. So kind of a catch-up trade rotation. We're not sure if that's going to be sustainable, but again, it's meaningful and notable to point out.
So Dan, talking about the Fed that you mentioned, they had a Federal Reserve meeting the 31st of July, and everybody's on the edge of their seats, always wondering what's going on with the Fed speak. Jerome Powell came out and pretty much reiterated what they've been saying the last several meetings and what the market's been anticipating. And that's pretty much that the inflation readings are definitely trending in the right direction. We had a little bit of a hot start to the inflation readings earlier in the year, but those have moderated, and now we've had some nice readings, as you indicated earlier. And as a result, the markets are pretty much pricing in that there's going to be a rate cut in the September meeting coming up. And quite likely we'll get another cut later in the year. So the guidance I don't think has changed, but the fact that he reconfirmed and didn't change gears, the markets took that as a positive, and everyone pretty much is under the impression now that we're going to get some rate cuts sooner rather than later.
And the other reason investors are so confident that rate cuts are coming is the Fed's been talking about inflation for quite a while now. And as you mentioned, inflation is kind of softening and falling in line. But the other reason investors have confidence the Fed will cut is because of their dual mandate. The other half of that dual mandate is looking at employment trends. And we're starting to see a little bit of weakness, just minor cracks in the labor market. And, Powell's been talking about that also a little bit. So again, reading through the lines, you can see that they're teeing up a September Fed rate cut, the first one in a while. So we'll point out that the Fed funds rate has been unchanged for just over a year at 5.25% to 5.5%, and that appears to be, high enough and for long enough to just modestly slow the economy and have the labor market slow down very slightly.
So Dan, in addition to the information we got from the Fed, which obviously was meaningful, we got some information regarding the state of the economy as it relates to gross domestic product during the course of the month. What was the news on that front?
Yeah, so mid-month we saw the GDP report for the second quarter, and that came in at about 2.8% annualized. So a little bit higher than expectations, which were around 2%, and a little bit higher than the first quarter reading. And as if we, sit here and think about, how economic activity is going to shake out this year, we've been saying for a while that we thought economic activity would trend a little bit lower this year than last year. So just to recap real quickly, GDP last year for 2023 was just over 3%. We think this year probably 2%, maybe a little bit more.
Mhm.
So again, we think there's going to be a slowdown in the economy, mainly caused by the higher interest rates that we talked about, but still fairly solid economic growth for this year. So Scott, as far as that leaves us with an outlook, we still have a fairly positive view on the financial markets and the economy. We talked about Fed's probably going to be cutting rates. Other central banks are already there around the globe. And the other thing we didn't talk about is the fact, corporate earnings continue to remain fairly strong.
Mhm.
So as we sit here in late July, second quarter earnings season, we're about halfway done. Pretty positive, solid results really
Mhm.
across the board from pretty much all sectors. So we still retain a fairly positive view on the financial markets, both with stocks and bonds.
So with that, we're going to wrap things up. As usual, I want to thank everyone for joining us and thank you for all your continued trust and support. And if anyone has any questions, certainly please don't hesitate to reach out to us.